Okay, I think it's time for us to start. So hello everyone and welcome to Forger Underwood's latest live M&A market update. Of course, it won't be live for you that are watching it on the archived video, but we welcome you all the same. My name is Kevin Reid, and over the next 40 to 45 minutes, I'll be asking questions of Forger Underwood MD Keith Underwood. Keith, give everyone a wave and a hello.
Hello, good morning to you all.
There you go, excellent. So the questions I'm going to put to Keith will revolve around the M&A market for the accountancy sector in the UK. It's great to be back for our first update show of 2023. There are a lot of developments to cover. Namely, buyers becoming more selective. Practices are facing multiple challenges and, of course, opportunities by definition. And as ever, the popular valuations part of our show will also talk about consolidators as well. Go in and share screen for the moment. And for those of you who don't know, Forger Underwood is a leading advisor to professional services firms, helping them with M&A advice through to succession planning, strategy and leadership development, among other things. And obviously visit forgerunderwood.com to find out more. Some final housekeeping before we kick off proper. We can take questions and of course we welcome them, and you're more than welcome to use the Q&A button to send them in. And we will broach them as they arrive if they fit into the flow of conversation. Otherwise, I'll hold them till the end of the session. And as I said, we're looking for about up to 45 minutes today, depending on how busy and questioning, I guess, you guys are of us. If you have any questions that actually you deem sensitive or you just like to have a chat, then please drop Keith a line at keith@forgerunderwood.com, and I shall share Keith's details again at the end of the show. And obviously, if you're watching a recording of this, then drop a comment into YouTube or just email Keith. Let's go back to our share screen. Lots of buttons for me to press here, but please bear with me.
Well done, Kevin, you're there. Yep.
Nearly there. Okay, so let's kick off proper with our first section of the day, which is around buyers becoming more selective. Keith, it's over to you.
Thanks, Kevin. Thanks for the intro. It certainly has been a very busy time over the last 3-4 months since our last presentation. The market is certainly moving ahead, a lot of deals, a lot of discussions, and I think a lot of strategic thinking from firms right the way from the smaller end, right the way through to the top 10 as to where they're going, what they really want for the future, and strategic planning inputs we've made, certainly for some of the mid-size and larger firms, has been, I would say, touching on new ground that they wouldn't necessarily have looked at 10 years ago, 5 years ago even. So what we're looking at is buyers are becoming more selective, driven partly by the PE activity in the marketplace. We have the old chestnuts, if you like, of the first 4 there, which I won't really worry about, but they affect every single deal and are the fundamental issues that have to be addressed, I think, for anyone selling their business, and indeed any acquirer looking at a target business to acquire. Charge out rates.
Would you say that flexibility has changed as far as staffing is concerned? What in terms of what that means?
I think flexibility. I think there's a rigidity in a smaller practice that we're coming across where, believe it or not, digitalization is slow to be absorbed, is slow to be adopted for change, and the flexibility of staff due to age, due to workarounds that they're currently using, is actually an inhibitor, more so than perhaps we would have seen pre-COVID, but it's coming out in sort of evaluations and DD exercises of staff flexibility as positive, negative in terms of the acquisition going through.
Thank you.
I think looking down those first 4 are fairly lock up. I think the only comment I would make there is lockup is still surprisingly high for a lot of practices, despite the inflation rate at the moment. And moving forward, potentially some of the clients might find difficulties over the next few months or a year or so. If there is a recession, I feel lockup is too extended for a lot of practices, and that we've been stressing and needs attention. Not a positive issue for a buyer either. If lockup is actually slack, it just means that the client's got to be brought on board in a much more rigorous recovery basis, which could be disruptive. So anything done to lock up would be very valuable for a number of reasons at this stage. But the point I want to bring on is the onboarding integration issues as part of DD. And this is predicated partly by better preparedness and commercialism by the acquirer, but also by any acquirer who has funding or PE capital behind them. It means the DD process has been enhanced and made far more rigorous. So we're looking now quite usually at 3 or 4 parts of DD, not just a cursory half day on site, but perhaps a financial DD by one party, HR DD, IT DD, and you get different parties coming through the business looking at various aspects from the buyer's perspective, which validates perhaps the information they have to hand, but more importantly, it looks very clearly at the integration issues that are likely to occur down the stream if the deal goes through.
Are cultural issues just not, is culture kind of integrated within DD itself now, as opposed to, it almost used to be the big thing, didn't it? Can the people get on? And obviously get on can mean different things.
Yes, it can, and that's a big, that's a discussion for maybe another hour, but or another day. I think the culture issue is very important. I think the sensitivity and culture issue comes out at the exploratory meeting up front, and it's either alien and won't go ahead, or is likely to be a conflict situation, if you like, not a battle situation, but in fact a difficult to absorb for the larger firm. But
so it's still there, but it's almost like there is now a more coherent and detailed post-cultural, chat DD. It is more serious affair now.
Yes, and I think the acquiring practice is perhaps more dominant in terms of the acquired business adopting their culture and adopting their systems. And
I've just had a question. What is lockup? How do you define lockup, Keith?
Lockup? Oh, sorry. Yes, lockup is work in progress and debtors. In terms of the lockup within the business that is usually funded by the partner's capital accounts, but sometimes externally funded as well through bank borrowings. And that's why that issue is important in terms of getting a deal for the larger firm, attracting particularly the ongoing partners into their business with a capital account contribution, but not obviously something which is excessive, which would have possibly needed for a extended lockup period. So I think in the differences between smaller and larger firms, the last point there, yes, there are differences, and smaller acquirers are far more flexible, if you like, on DD, and might still do the half day in the office looking at a few files for standards, and doing a bit of DD, legal DD on contracts, and also looking at the financial modeling, if you like, as to how that is going to contribute and the funding that's going to be needed when the business is brought on board. So there are differences between smaller and larger firms, but the larger firms are becoming at the very top end. Obviously, the DD is put out to specialists in those areas, and you'd find a legal DD being undertaken by a solicitor's firm, etc., etc. So I think there are differences. Deals are still going through at both ends of the marketplace, and indeed there's an appetite at the smaller end, with the smaller independents, as we'll see down the line on the next screens.
Okay, shall we stop sharing now for a second? So we covered lock. Sorry, I had to disappear for a second. We've covered lockup then, Keith. We've got it nicely defined for the audience.
Yes, I think we have. I gave them an outline in your absence, Kevin.
Where does the digitalized practice fit in all of this as far as buyers are concerned? It's something we've discussed a few times along the way.
Yeah, I think digitalization is becoming much more important, and it's part of that DD process, that line 5 on the last slide, in that a buyer wants to see that both the clients and the staff, if you like, again, that word flexibility, have the flexibility and have been introduced to digitalization. There's a reluctance to invest time in onboarding from perhaps a portfolio of clients which haven't really been exposed to digitalization, are unaware of the changes that are going to be upcoming. So people do like to see that there's progress, perhaps resistance identified within the portfolio group, and more importantly, that the staff are taking on, are flexible enough to take on new systems.
The point I was going to make there, Keith, was that if you have a digitalized practice, smooth systems, automation, that doesn't necessarily mean that you're attractive for those particular systems themselves. A buyer can still take you on and change how you do things, change your tech to suit them. But it's more that you've gone through that process. Your staff are amenable to digitization itself as a concept.
Yeah, I think that's a good point, because the new digitalized practices have only been around maybe in the last 5-10 years. And they're coming to a stage where the founders are looking either for sale, or they're looking for growth and outside organic growth as well as acquisitions. Most of these digitalized practices, however, are based on a platform which has been developed to various degrees using Xero or QuickBooks or whatever as the base platform, but then add-ons to enhance the service to the clients and also in terms of the process and workflow. So that is becoming a difficulty, and we've had a couple of deals between what we call new digitalized practices, where really the larger firm or the acquiring firm, who has obviously got their own foundation business, their own foundation IT, have actually are really interested in the portfolio being uplifted off the target practice and just inserted and brought onto their own business platform, which means that the IT investment of the smaller business, usually, which is quite an extensive cost, is going to be junked, if you like, and really has no value, which is a bit difficult because a lot of these digitalized practices have put a lot of money into the process and the IT, and that doesn't necessarily have a value passing it on to a larger firm with its own platform.
But it doesn't have a negative impact in the sense that a lot of this tech now is cloud-based, so you're more than likely to be on subscription rather than kind of very long-running licenses.
No, that's really prima facie what the model offers. The people have started it up, they're on subscription. There's very little lockup from that point of view, and therefore that's not a fact. You're absolutely right, that's not a factor. But the point is, the investment in the software is perhaps lost, and there is a premium attached to the software development and the ability of that software in the larger firm, the ability of that software to perform efficiently in the larger firm. And that is lost possibly on the sale of a digitalized practice to another digitalized practice, which is larger but more established.
Yeah, fine. Thank you very much, Keith. Let's keep. We're starting to talk about the seller. Let's move it on. Okay,
well, we then move on to some of the considerations we're looking at these days, which are actually a rehash, I suppose, of what they have been for the last 10 years. But there are some areas in here which are becoming more emphasized through the buyer-seller discussions. and continuity is important. We go down there, maintaining sustainability of profit. We've had a few businesses, again in the digitalized side, which has been high growth and putting on sort of 30% per annum, and the maintenance of that profit and fees and the growth, which is part of the price that's being paid for that business, has to be validated. And
How has any of
realistic.
this moved on, Keith? You know, if we're thinking of this from an update term, what are the trends that you're seeing that relate to some of these points? Because obviously a lot of these are kind of core considerations.
Yes, they are, and have to be addressed. And I wouldn't want to spend too much time on this slide, but they're just really sweepers to make sure that areas which have caused problems and where deals have fallen through in our negotiations, for a buy side or a sell side, are actually addressed by the vendor before he comes to the table. So, you know, the commercial contract situation is becoming more and more important. Staff are so key. Subcontractor contracts need to be reviewed and make sure there are non-poach agreements in those, protecting the purchaser of the business. So you've got to keep those up to date. You've got to keep those rolling on. The idea of bringing a file out of the desk at DD and saying these contracts were signed off and haven't been changed for 10 years is no longer appropriate, because things have moved on in HR and contractual arrangements and protective arrangements on covenants.
Is the point, Keith, that going back to the previous section, the buyers are not only becoming more selective, but they're becoming harder nosed? The negotiation, the DD is more stringent.
Yes, I think that's fair, Kevin, and I think that's, you know, they're paying money maybe to outside parties to do the DD, and therefore, particularly with outside funders involved, they have to protect themselves as a management team, and are therefore looking very carefully at the results of that DD, which for a smaller firm, which is perhaps the DD undertaken by the managing partner of the acquiring practice, which has been historically the way it moves, or predominantly the way it moves, you know, that is no longer the case and no longer the norm for larger acquiring acquisitions.
The second last point on there, Keith, around do you price appropriately, has that become more of a kind of like an acid test or barometer for the optimal running of a practice? If you're not charging properly, then it just means that a lot of other things are likely to not actually be in place. And obviously in an inflationary period, you know, that a buyer is going to be really wary if your prices are half or third of what they're charging.
Well, no, absolutely, and all that is integrated there into maintaining profit. Do you price appropriately? Have you kept up with inflation? Are you ahead of inflation? Because really your profit shares should be increasing as well as your fee to take advantage of the profit moving ahead within the business to make it a healthy model. You're absolutely right. It is, pricing is important. I think it most likely affects the smaller practices more than where you have a sole practitioner maybe who has not been forceful enough on his price increases, has fallen behind the market, and therefore it becomes quite a difficult sale for him when he wants to exit.
He or she or they, Keith.
He, she, or they, whichever you wish. Yes, I think the larger firms, I am concerned they're not putting up their fees sufficiently for the current marketplace, but I think there will be a catch up over 2 years. And although people are increasing, as we see from the Managing Partners Forum, some are increasing by 5 to 10%. Others are certainly increasing certain services by 5 to 20%, with particularly audits going up in the higher level of that percentage increase.
Keith, juggling all of these things while thinking about a sale or a merger, and you will have seen this many times. I also appreciate that this session is not a general advice session. It is an update on the market. But how keeping all the balls in the air as such while looking at a sale or merger, there's a lot to keep going. There's a lot of thought and preparation that needs to go in, and perhaps doesn't go in enough.
No, well, that really hits at the whole structure of the LLP and partnership model and sole practitioner model. It is enough time spent in preparing your business for an event down the line, whether it's retirement or sale, merger, or indeed acquisition. And I'm afraid accountants, and being one myself, we spend a lot of time on the business without putting our head above the parapet and looking around and seeing what's going on. And that's why we say in that very bottom line, we keep on advising people, and more are taking it up, that the profiling before entering the market, before the event, before you want to make the acquisition, before you want to make the sale, is so important.
In terms of the smaller practice, Keith, you know, obviously sole practice or micro practices, they will have a modicum of a relationship with some of their clients. For others, it will be very much standard compliance offering. Where do they kind of sit in this market at the moment? Are people just after their fees? Can, you know, if you've got a well-run practice that's digitized and, you know, you're able to automate, you're able to perhaps offer some ancillary services along the way, which should be feasible even in a one or two partner firm. Can the value really move about, or is someone just after your block of clients? They don't and not care about the rest?
No, the block of clients, I mean, see, the profitability is the key, to be honest. And we'll talk about EBITDA later on, but the profitability is the key. And you know, I always use the example of a £750,000 practice we sold, which only had 40 clients. The proprietor, sole proprietor, 100% owned, was looking at a profitability of about 500,000 per annum. And that model, which we haven't seen replicated elsewhere, to be honest, it is an unusual model, but it just differentiates from the sort of traditional practice, which maybe only looks at the old 30% profit being sustained out of a general practice, which hasn't perhaps focused on service pricing and general advisory that this particular practice had done. So there are different models, and they will attract different prices in the eyes of the purchaser, and to an extent, not just in the eyes of the purchaser, but in terms of the money that's transferred as a consideration.
And just my final point before we move on to the next section, and kind of just, if you kind of summarize some of the points you've or bring together some of the points you made, coalesce them. If a firm is digitizing and is well run and is small, does that impact its value, or is it, as you say, is it more about the upshot of digitizing? It means you've got free time to then charge more, provide more value. The digitization by itself isn't just not the be all and end all.
No, I think see, the whole thing again is profitability. If you're going through the early stages of digitalization with high cost, training of staff, retraining of staff, changing roles, you might not actually be adding too much to your bottom line, which means there's a scalability issue. And a lot of this digitalization is bringing scale. And that's why people are interested in adding fees, because they believe there is more profitability, which there is indeed. As you grow in size, normally there is a very low marginal cost to bring on new clients, hence the bottom line benefits. But it goes in steps, it goes in a sort of a staircase situation. You optimize and then have to bring on more staff. You have to actually increase cost in your IT spend, and then you have a sort of flat period, and then you go up and optimize again. So the idea is to be able to show that you're aware of these optimization areas and sell possibly 10% off the top of that optimization, which means your profitability will be good. You will have shown that your model actually sustains itself through increased investment and bringing on more clients, and then there is something left and something attractive for the buyer down the line.
It's interesting that the digitization process in itself isn't a quantum leap for the firm. It doesn't automatically then start being able to bill double what it did before. There are ongoing costs, as you say. There's people, training, development, recruitment to add into all of that mix while you develop more services or a better offering. It is still a relatively organic and, you know, baby step process.
Oh, absolutely. I mean, say it doesn't. You still got to get the clients through the door to put them onto the digitalization, whether that's through your website or indeed through direct contacts.
I daren't have mentioned the clients, Keith, because obviously that is an issue in itself. I'm sorry to take us on a slight tangent there. I just think it's a really interesting point. Let's keep these slides shared and let's click forward. Should we move past this slide? Or do you want to stick with
No,
this
I
for the
think we'll
moment?
stay on this slide for a moment, but we'll move past it in a minute. I mean, see, we've got onto the valuation section here now, and we've spoken about some of the trends. I suppose go on to the next slide, Kevin. That'll be better. We'll come back to this one.
We've teased them there, Keith.
Yeah, well, that's it. Now we close down the session, and they won't know what we're talking about or what's happened. So the valuation market at the moment has changed. I alluded to that at the start of the presentation. There is increasingly a feeling that the PE-backed consolidators, of which I think we've spoken to about 16 of them, and there might be more around, have their own M&A operations and are plugging the marketplace. I think the word here is bombarded. Yes, bombarded by PE consolidators. So it's not unusual to ring up a managing partner to say, I'm sure you've been approached by some of the consolidators, and they're saying, yes, we get about 2 or 3 solicitations every week. Now, that is interesting, but it's also interesting in that the targets that are being approached right the way through the size of practice have already made a decision whether they wish to remain independent or not. Yes, money will turn some of them, but they're usually fundamentally looking at an independent role going forward, or perhaps a sale at a certain date, maybe now, maybe in the next few years.
Would you say a lot of those considerations, though, Keith, are being undertaken within the managing partner's head without it actually being really strategically worked out, shall we say? I'm not trying to kind of cast aspersions on all of our all the bosses.
No, I think it's a good point. I think increasingly there is openness and transparency in this area. And what we usually get back is that they've had an open day session, they've had a strategy session, either at the executive level, executive committee level, or indeed among all the partners. And the feedback is, and they're relating to us what the feedback is about selling out now with a lump sum as against a continuation into the future for the next, what could be 10 or 20 years for the younger partners, taking full profit shares, because obviously if you sell the capital now, you don't get the full profit shares in the future.
Well, I was going to say,
I think
but deciding that you're going to carry on doesn't mean that you've sorted out your succession planning.
No, not at all. I mean, you still have to be succession people there, but then the consolidators are not necessarily providing succession either. They're providing cash exits. And depending upon the model of the consolidator, and I would stress they are all different, you know, being some at 100%, some at 50%, some at 51%. Some of them have people to plug in. So people like assets, which are large enough, would have people to plug in for an exiting partner, and would move people around. Others do not have that pool of people and are looking to the practice that's being taken over to find its own succession, which actually is the reason they've gone to a consolidator to sell out. But it does become a situation they don't have the succession in-house, therefore they're looking at other alternatives, and they will look at the consolidators with the higher equity holding partners who are exiting, taking the money off the table.
Are these firms that are saying to themselves, no, I don't, these consolidators that are approaching me, their model doesn't fit for our firm? Is that driving some of these kind of independent, organic, you know, by tradition, organic growing practices to actually look at scaling themselves?
I think there's a question of loss of autonomy and direction and strategy, which comes with selling out to a consolidator. I think but it is to a large extent the custodian model, and particularly taking into account the views of the younger partners who have different views on this, and some of them want to take the money off the table and will go with a consolidator offering, and that's fair enough. But others are looking at an independent role, directing the business strategically for the future and staying independent. So
my point really was in a world
of situation,
in a world of consolidators, Keith, does that mean that these independent practices need to bulk up? Do you think some of them will feel they need more mass, or that they can just exist in as they are fundamentally?
No, I think commercially, when you look at the commercial accounting model, scale is important, whether you're a consolidator. In fact, even for a consolidator, it's absolutely critical to get the scale and the next deal across the line, because the money is burning a hole in your pocket, and the PE firms do not like to see money which is not being spent. But the independent LLPs, there's a point there, they've become very active in the market. They've realized that scale is important. The IT costs that they're seeing and the staff costs for highly skilled individuals are going up, and they need the scale to improve the profitability per partner level. And that is working quite well, and partly because audit has become a profit center rather than a cost center, and an area people 10 years ago wanted to get out of. But there's a lot of trickle down business from the top 4, perhaps the top 6, of very good margin business, which the practices below that level are now picking up and translating quite nicely into their bottom line.
How far down can that trickle, Keith? You know, I mean, outside, I mean, there are, again, below the 6, you've then got another 20 firms or so knocking about, and then it really, you know, the tail kind of starts doing that. How far down the line is this audit work going?
We're seeing people with sort of audit and 4 million of fees, also seeing it drip down from those 10 million pound, 20 million pound firms as well. So there is a gradual osmosis, if you like, through the different levels of fees, which is actually favouring audit down to 4 million. I mean, say we've still got the situation that at 1 million, you will still find practices with audit, but it's becoming rarer, and the regulatory side of that and the cost of running audit and trainees and all the rest of it is just eliminating that from the 1 million fee level practice.
Very good. One more question, Keith, because I know I'm kind of like running you around a dishwasher here around all your points, but for these independent LLPs still being active in the market, how are they doing this? Where's the cash coming from? Is it stuff from their, you know, under the mattress, or is it bank funding?
I think the last few years have been quite profitable, so there is a bit of a cash surplus around, but it's basically coming from their own pockets. And even if they get outside financing, unless they want to give away some equity, which they're not willing to do, most of them at the moment, they are actually funding it a little bit through direct debt, but otherwise through their own pockets. And that is interesting. I think we go back to the slide above, if we could, the previous slide, Kevin.
Yeah,
that I think explains.
See what I can do. There we go.
So what we're trying to do here, and it'll follow on from the answer I was given, is we're trying to show the activity by size. Across the top there, you've got the practice sizes of up to certain levels. Top ones being 100 million there. I didn't bother to go any further than that. And then you've got the larger PE-backed consolidators on the left, PE-backed consolidators, smaller than the larger, obviously. Investor roll-ups, larger LLPs that we were just talking about, smaller independents. Now, these crosses just indicate the activity levels that these particular groups are going to be interested in terms of practices. So there's very little interest groups. The number on the right-hand side shows the number of consolidators and various sectors of this marketplace that we would see in the marketplace at the moment actively operating. So larger PE-backed consolidators may say 1 to 3, assets is one of those, obviously. PE-backed consolidators as well as 5 or 6. Investor roll-ups with outside funds, again another 5. Larger LLPs, many, a lot of them regional, a lot of them national, and back in the business looking for merger acquisitions. But the point is, on that left-hand column, the larger PE-backed consolidators are buying 100%. Then going down, some of the backed investors are looking at 51% upwards. And the larger LLPs are, of course, making merger acquisitions. So when they take over a firm of 10 million, they might be taking out two retiring partners, but taking in on a equity exchange with their own equity another 6. So that is not a cash situation, really. It is a merger situation. So their actual outlay there is less than obviously the consolidators who are buying 100%.
And that builds them a massive expertise. It builds in succession planning as well.
It brings on, if you're lucky, younger talent from the other practice, ability to motivate them, and more importantly, the ability to raise the profit share potentials, because the larger LLPs are now getting some pretty hefty profits per partner, which is the counter, if you like, to the consolidator. So we've been talking to people who are doing $500,000 of profit per partner, whose strategic plans are taking them up to 750,000 per partner.
And that's a smaller practice.
The next 5 years. And this is a real counter to some of the consolidators, and the able young partners can aspire to perhaps considerably higher profit shares than would be the case if they sold out to a consolidator.
That's really, really interesting. And obviously, as we can see on that chart, if you are 5 million to 10 million pound firm, they are the firms that are getting approached 2 to 3 times a week because they hit so many of the marks.
I think the other thing of interest in that bottom line, these are the multiples that people are talking about at the moment, and we're seeing deals go through at these levels. Now, if you're 100 million, let's just take that extreme. You're extremely valuable to a PE-backed consolidator because the F at the bottom there stands for foundation business. And there are discussions where multiples of 10 times EBITDA are possibly on the table for a foundation business with one of the larger PE-backed consolidators. Some of who are not in the market at the moment. Our whole idea of foundation business is it's their first acquisition. So they're not in the market at the moment. So there are a few standing off waiting for those opportunities, but the number of £100 million fee independents who actually are considering going with a consolidation are limited. So then you go down that line, and the interesting thing is that the multiples have most likely gone up a bit. So at the very bottom end of 1 million, we're still seeing 3 to 5 times EBITDA, which equates, as you'll see on a slide shortly, to a multiple of about 1 times fees.
Yeah.
And you just have to do the calculation of 30, 30, 30, 30. You should really be looking at a 20% super profit on businesses, which don't normally apply under 1 million, but above that, a sort of 30%, about a 20% super profit. And that 20% times 5 EBITDA, after charging a notional fee for the partners, brings you back to a multiple on fees of about 1.
We're over 40 minutes at the moment, Keith, so I think we're looking at 5 minutes for wrap up or so. So just bear
that's
that in
fine.
mind.
But I will just stay on this one for the next minute, because I think it's an interesting slide and does bring people up to date with where those multiples are going. The benchmark multiple, it would seem, is going to be the HG Capital sale of assets, which has been mooted for this year. I don't know whether it will go through this year, but it's been indicated that they're looking for 10 to 15 times multiple. if that is not achieved, and they only get 10 times, then obviously these multiples on the bottom line are going to concertina back and become lower, because the whole ethos of the PE firm is to satisfy their investors with a chunky premium on EBITDA when they sell on at their event after 4 or 5 years to the next PE house. So
prices get depressed further down the line.
Prices could get depressed, but I mean, see, that's why people are waiting for the HG Capital multiple that they achieve for the sale of assets. I would bear in mind that out in Singapore and Hong Kong, where we also operate, particularly in the corporate services side, we are doing deals at 17 times with PE-backed firms. So it'll be interesting to see what happens with assets, but it will be a benchmark for the perhaps European and UK marketplace going forward in terms of the accounting sector.
Very good. Where do you want to go now, Keith? Do you want to skip a couple of slides?
I think the valuation market, I think we covered that previously. I think what we'll say is just one point there on that valuation market, the one up from the bottom, two up from the bottom. All the acquirers have different models, geography, and intentions. They are all different. So when you're flattered by an approach from a consolidator or indeed from an LLP, it is worth just sitting back and realizing that you have some strength and you have some leverage here, and it would be worth going into the marketplace and looking at your value through the eyes of perhaps 3 or 4 different acquirers, because it is a seller's market at the moment and is likely to become more so over the coming months. So that's the different models, all different, and you have the choice as a vendor where you'd like to go. Price ranges, EBITDA versus salaries, the more you want out as an ongoing salary, of course, post a deal, reduces the EBITDA, and that's something that that is something to consider when you look at the values you're going to achieve, and is a factor in the different models offered by different consolidators. And
many of the models do offer continuing work, doesn't it? Salaried work for people selling their equity.
The salaries usually come down to anything between 80,000 and maybe 200,000 a year, depending upon geography, location. A lot we're seeing in terms of valuations are going through at about 100,000 or 120,000-30,000 per annum for ongoing partners working as directors.
We're on 45 minutes, Keith, so we should just keep this all wiggling along. Valuations moving up slowly. Is there a particular reason?
Yes,
moving up's good, of course.
I think the supply is there at the moment. I think the supply might get a little more difficult to bring to the table for discussions. I think what we should do, though, more importantly, I am seeing, as we saw on that previous slide, that the multiples are going up for certain types of business, but it is only slow. And the relationship between the EBITDA and fees, which I think is on the next slide, is not unrealistic, because we have here fee multiples down the left-hand side, which are fee multiples, and EBITDA multiples at the bottom. I mean, so even if you're talking on that previous slide about 6 or 7 times EBITDA, it still takes you to, on average, I mean, see, this is all a little bit hypothetical, but on average profitability after notional charges for partners, you're still looking at a multiple of fees of 1.4, 1.6. And as I say, ignoring EBITDA, we sold that £750,000 practice, which I mentioned earlier, on a multiple of 1.5 a few years ago. And we've sold a reasonable size 2.5 million practice sort of 5 years ago on a multiple of 5.5 to another LLP. That's an EBITDA multiple of 5.5. So these are not really prices which are out of the world. For the foundation business and the larger firms, it's a price they couldn't get from another LLP or what I call a trade sale. So yes, it is different. Down the line, though, there is not a significant difference. There is a marginal increase in what you'd be getting a trade sale against a PE-backed consolidator sale. But bear in mind, the one point to bear in mind here is the consolidator sale, if they're buying the shares of your business, they would normally look for the lockup to be retained in the business and not be distributed to the vendors. And we've had 2 occasions now where competing consolidator offers against LLP offers have actually fallen on the basis that the LLP offers did allow the working capital to be distributed post-deal, and the consolidators wanted it retained as part of their price, part of their offer. So it had to be left in the business, and that, with a significant lockup with some businesses, is quite a key element.
Cash will always be king, Keith.
Cash will always be king. You're absolutely right.
We're running at 48 minutes, so we really appreciate everyone for sticking around, and I'm hoping it's because it's really, really interesting stuff. I'm going to stop the share at this point, and just get back to rounding things up. So Q&A, if anyone has any questions, then feel free to ask. I'll just keep an eye on that. We do have a question. Let's have a look, see what we've got here. For smaller deals, Keith, what percentage of them have 2-year clawback versus 1 year? And do you ever see 3-year clawbacks?
Yeah, we saw 3-year clawbacks during the COVID situation because of the uncertainty. I mean, it does just cover risk. That's what we're talking about here. We're not talking about payments stretched over 3 years, but over a 2-year period. What we normally say is under 200,000, you might get away with a 1-year clawback if they're homogeneous type fees without any exceptional large ones, but you can always ring fence the larger ones and deal with them under a different term, and maybe make them 2 years, but normally it's a 2-year clawback.
We have no more questions at this point in time.
Oh, right.
Which is fine.
Well, if anyone wants to come back on a direct basis with something, obviously, which is perhaps they want to deal with discreetly, very happy to talk to you.
I'd just like to say thank you, everyone, for joining us today. You can see Keith's details on the screen, keith@folgerunderwood.com. If you'd like to have a chat, he'd really appreciate it. Otherwise, follow us on YouTube for more of our videos. Visit folgerunderwood.com to find out more about us. Read our articles about accountants. We're also on Twitter @FolgerUK and on LinkedIn. We've had one more question. Shall I interrupt my outro for that? I think it's worth it. Bear with me. Before we say goodbye. Do you deal with Irish firms? I think I know the answer to that.
We certainly do, and we're currently handling 3 or 4 deals in Ireland at the moment, and a couple in Northern Ireland. Yes, so we're covering Ireland certainly quite actively, both from the point of view of accounting firms and in some of the specialist consultancies as well, and trust companies.
There you go. A very clear and affirmative answer, and I can certainly vouch that it's been busy over the pond. Ladies and gentlemen, thank you very much. Once again, Keith's details on the screen. I will stop the share. Keith, please say goodbye.
Thank you very much. Thanks for attending, and I think we're looking forward to an exciting 3 months, and I look forward to briefing you again, maybe sometime around about June.
Thank you, everyone, for joining us.
Care.
You will, of course, get a link to an archived version of this recording, which will be hidden away discreetly on YouTube for you all to access again. Again, thank you very much for joining us. Join us again for more webinars and insight over the forthcoming year. Bye.